Welcome everybody. This is part 4 of tonight's event of the Opportunity Zone Meetups. Our topic for this evening is combining Opportunity Zone investment with insurance banking. And we're going to close in this part 4 with a panel discussion and a live case study where Unbridled Wealth is currently applying this model to the purchase, restoration, and leasing of a historic building in Florence, Colorado. So we'll go to the first slide here, which is about Unbridled. I'm going to give Sean the microphone and let him talk, and apologize for jumping back and forth, but I missed all my technical gear for tonight. So Sean, if you just talk about Unbridled, that would be great.
Yeah, so Unbridled Wealth is comprised of 21 companies. This is the main headquarters, Grant Street Mansion. This is the example where they're putting $400,000 a year mortgage through a life insurance policy, and both the bank and the life insurance policy loan are paid off in 15 and 23 years successfully. And they're netting, it's Stan's retirement plan, so he has $715,000 a year tax-free that he can pull out of the policy as a tax-free retirement, and he gets the rent roll because the building is paid off. The rent right now is around $540,000 a year, and so he has about $1.2 million when he turns, I think it's 80. When he turns 80, that's his retirement income. So he's combining the tax-free banking. This is not an Opportunity Zone investment. However, they used tax credits. So they came in and bought a deeply undervalued property that was a historical building, and they got $920,000 in tax credits when they bought it. And then
historic restoration tax credits.
Historic restoration tax credits. Some were state, some were federal. And so since they didn't need all the state tax credits, they actually sold it on the open market. I think it was to Best Buy is who gobbled that up and used it. But they used that to do the additional renovations to the building. They used that tax credit and flipped it back into the building. So that's
yeah, I'll take it from there. If you get a chance, go down to Unbridled Wealth, work with Sean or somebody down there. The inside of this building was beautifully restored. I mean, it is an exquisite demonstration of Victorian everything. And what Unbridled is doing is it's now on a march to pick up historic properties that fit their criteria, as Sean described. And as it turns out, one of them is in an opportunity zone, so we're going to talk about that here in a moment. Yeah, Sean, if you would describe this chart.
So in this chart, what you'll see is the $400,000 a year going into the life insurance, the cash value at the end of year 1. They're in the 3rd year of doing this. So this is beginning year 1. We're right about here. Death benefits, $8.6 million. So the loss of access to cash, which Karl mentioned, is about $117,000 year 1. And so what they do is they actually run the life insurance, they run the mortgage through the life insurance and pull it back, borrow against the life insurance policy. They pay interest on the loan because they're only doing it for 5 months out of the year. And the net loss in the first year is $121,000. So by the 5th year, that is the most money that they're losing. And what you'll notice over time is in the 10th year, 15th year, 20th year, let's just use the 15th year, for example, A and B Bank is paid off. So what they've done is they've moved the mortgage from A and B Bank to the life insurance policy. So what they've got is they've got a really large outstanding loan against the policy, and they use the rent rolls to pay off for the next 8 years the life insurance policy. So the net result you'll see is this is Stan's retirement. So they put in a total of $6.1 million. They have a $15.7 million cash value. The death benefit is $25 million, which would pay off anything for the business that was outstanding, which in this case there's nothing left to pay off on the building, but the money would go back to the business. And you can set it up to where it goes to the heirs as well. The net gain is $9.5 million. And the cost of capital freezes because both the institutions are paid off, A and B Bank and then finally the life insurance, which realizes a net gain of $4.4 million, $7.5. and this is in the 30th year, they're still putting 110,000 in per year in premiums instead of 400,000 because you can drop it that low. But what you'll notice is there's an $825,000 roughly gain in the policy after putting in 110,000. So now what they've got is we've got a $700,000 tax-free gain per year they can pull out of the policy and just use for retirement. Now in this column, since we don't know people's tax rates, we didn't put that was a deduction, but since it is, whatever you can deduct as a business expense, if you set up an LLC, for example, you can deduct that interest. So it's actually better than it shows, but we just want to be conservative on our numbers. And interestingly enough, they found cash in the 3rd year. They haven't taken a single loan on the policy. Interestingly enough, because they have 21 companies, so they just found money elsewhere. But yeah.
So questions on this slide?
Does that make sense?
So the total cash surrender value, that's what you're putting into the overall business, or what is that?
So this is what you've put in, the premium. This is what it's grown to, tax deferred. And once it reaches, whatever it reaches, the dividends fluctuate. So, they're guaranteed to be 4%, and they've been as high as 13%. So they hover around 5 or 6% average. This is the gains over what you've put in. It's what it's grown to against what you've put in.
You could borrow against if you wanted to.
Yeah. 95% of that is available for loan.
Right, so, and keep in mind, again, this is an insurance question that didn't occur to me originally, but Jonathan clarified it for me. If the insured should die, the only thing that's paid out is the death benefit. The cash value disappears, okay? It's not sitting there. You don't get the death benefit and the cash value. So, but that, for those of you who are entrepreneurially minded, suggest borrowing the maximum against the cash value for anything that might gain a rate of return that would be higher than what you would be paying 5% interest on. So if you could, and the fact you've borrowed it at 5% doesn't stop you from lending it out to someone at 10, 12%.
They're doing that now. They started up a business where they're loaning it out to new startups. Of the 21 companies they've started, they started up one of the companies and they loaned it at 6%. They put them on principal and interest. When the business got in trouble, they switched them to interest only. And so now they're back on their feet. Now they can pay principal and interest, which lowers the interest rate, annual effective interest rate down to 2.73% for the business, and they're charging 6%. So you can become your own bank, basically. So this is the Bosworth Mansion. We're supposed to move into that last week. Didn't pass inspection yesterday, so hopefully next week. This is the Opportunity Zone. This is Stan had a $367,000 stock that he sold, so he had a $73,000 400 tax liability, cap gains. And so what they did is they took and they divided that number by 5 years, and they put in $14,000 a year into the policy. The tax bill that's due in 7 years is $62,390. And we kind of spreadsheeted it out just to show you that the death benefit is here, the cash outlay is here, and the cash value is here. And that's by year 30, 20, 7, and 1.
Why did you divide the tax liability by 5?
Just to spread out the premiums, because in life insurance policies, if you write one single check and walk away, it's called a modified endowment contract. That makes the gains in the policy taxable. So if you just do one check and walk away, it's not as effective. You're going to have taxable growth inside the policy. So we spread out the premiums divided by 5 into 14 grand a year, so we could stagger it in instead of a one-time lump sum installment, if that makes sense.
By doing that, still deferred the full $73,400 of tax liability?
With the Opportunity Zone.
Yeah, so the way the Opportunity Zone works is when you invest your capital gain rollover in this year, in 2026, you're required to pay the taxes on your current capital gain. So some people, in anticipation of paying that tax, even though it's reduced by 15% because you've held it in there for 7 years, they want to make sure they have cash available to pay that tax when it comes due. Now, some businesses, like this one, actually, upon retrofit, they're looking to lease the property for retail, office space, things along that line. And I did some analysis. I believe this is a 26,000 square foot facility, and comp rates in Canyon City, which may not be perfect, but it's the closest I could find, were $25 a square foot. So if you've leased out the entire property at $25 a square foot, it's generating a lot of cash flow. And you can pay through that cash liability to the investor. That's one way of doing it, is just taking it out of revenue from the project. But in this case, because the way he's got it structured, he wanted to make sure there was cash generated within the policy to pay that tax liability when it came due in 2026. Yes, Ben?
This is a more general question, and forgive my ignorance. How long do you have to deploy a capital gain to shield it from taxation? Okay,
so this is actually, the question is, how long do you have to deploy a capital gain in order to gain the tax incentive? And this is one of the actual greatest challenges of opportunity zones. It isn't all the other stuff, it's matching your time frame with the investment, with when the investment's ready to receive money and ready to deploy money. So the rule is that as soon as you recognize the capital gain as an individual or a business, then you have 6 months from that date in which to invest that money into a fund. But what we found is that if you have invested in a pass-through tax entity, such as an LLC or a partnership, that capital gain is actually not recognized until January 1st of the following year. So you have until June 30th in which to make that first investment into a fund. Once you make it into the fund, you've met the first criteria for it to qualify for all these tax incentives. Now that business, the fund has a period of time, 6 months, in which to invest that money. But again, the new interpretation is that if this is the first dollars into the fund, you don't have to recognize those until the following 6-month reporting period. So if, for example, you had invested into a fund on January 1st, and this is the first investment into the fund and has not reported before, it actually doesn't have to deploy that money till the end of December 31st of that same year. So you get a little bit more than 6 months of time for the deployment to occur. Now, once, if they deploy it into a property, you've got to do it within that time frame. If you deploy it into a business, that business, if it has a business plan that lays forth a rationale for the use of that funds, has 31 months in which to use that money to roll out a project or buy a property and develop it or do something else. And this was in anticipation that even in a good project, the need for permits or setting up contracts or other things, that it may take time for you to work through that deployment. And that's true for both a business and a real estate and development project. So yeah, so it's 6 months plus 6 months, sort of, just to be precise. So in this case, Stan sold some equity and recognized capital gain. He then puts that money into a fund. Within the fund can then buy insurance on him because it's himself, where if he was an outside investor, we'd have to have the business relationship strong enough to justify that. But we could have taken out policies in certain other people, other members of the management team, other people in the company, key contractors, all kinds of reasons for doing that. And the business would own the policy, but the insured would be whoever's named in that policy. Now, if that person is like me, 65 years old, not the lowest premium that's going to be paid, it still makes sense to do this, but they don't have the ability to insure my daughter, where if I'm doing my own deal, I might buy my policy different and take advantage of the lower rate that's associated with that. But here, what happens then is as the money comes into this, Stan can then borrow money in addition to his money, using his money as the down payment, leverage this with a commercial mortgage, do the retrofit, and get enough money for operating expenses until this thing cash flows positive at break even. And at that point, then the cash flow from the business can be used to pay the premiums each year, assuming there's enough cash to do that. And that's why we're looking at different modeling ratios to make sure we understand where that limit is at. But if you have enough money to pay your expenses just pay the premium, and the premium is large enough cash value to pay your expenses, then you're definitely in the zone. And so you'll cycle all your money into the policy, borrow back against it to the limit, pay your expenses, do it all over again the next year for 10 years. And then as we were modeling this, depending upon cash flow and the value of the property you borrowed or bought, at some point you may be able to pay off that entire commercial mortgage or lease, and then you can turn around and start paying off your loan within the policy to improve the cash value if you just want to do that, or you can continue to borrow against it to the max to try to grow that business or put it into another business or roll it into another project. It just depends on what your needs are going to be, but you have the ability to do that throughout the entire time period.
So in here, so you had $367,000 total that went into the fund. So that's there. The $73,000 tax liability, that's a bill due to the IRS that turned into $62,000 that's due in 7 years, right? Is that how that?
Yeah, so what he did is he put the money into a policy which is generating value, and he set the premium that he was paying high enough to assure that the cash value at the end of the time period was large enough to pay his tax liability. So
Okay, I see. So that was set up, okay, so he did that purposely so that in year 7, he just pulled out $62,000 of the $85,000, sent it off to the IRS.
Right.
And everything else keeps.
Right. That means he's always got control of his cash flow, and he's not caught short on cash when he needs to make that one tax payment in 2026.
And that's a 15% reduction from 73.4 to 62.390.
I'm going to say yes.
That's the most amount of reduction that you can get when you put it into a opportunity zone? I thought there was like a stages if you left it.
No. If you put it in, if you put it in 5 years, you get the first 10% reduction. If you leave it another 2 years, you get another 5 or a maximum of 15% reduction in your original capital gain, the one that you invested in the fund to begin with.
And then any stock that you have within the company, you can sell for the tax-free. That's where the tax-free part comes in from the capital gains.
Yeah, so that once you get to 10 years, your new investment, that's the one that's tax-free. So if we've talked about real estate, generally we'll have a ceiling or maximum gain that you'll expect from any form of development. It'll come up and then it may continue to appreciate, but it plateaus to some degree. We looked at people who are doing solar panels, which come up and flat plateau because they never have an increase in appreciation, even though they're cranking money, cash flow year over year. So some people are doing opportunity zone solar grids. But if you do a business, depending upon its growth rate, has an unlimited upside potential. And so it may actually have far greater tax benefits at the end of the day than a piece of property. And we have some people who are doing hybrids where they're putting like an incubator, accelerator, or an innovation hub inside of a property. So on this particular one, if they took 25% of this property and put it into an incubator, and then they traded out the rent for equity in those businesses, they could, at the end of the 10-year time period, find themselves with all these benefits, plus they have an equity position in all the different tenants they brought into their incubator, and all that would create a potential higher gain if they had a winner out of all the businesses they brought into that particular property. You can see we can continue to go on and on and on. But it gives you all this capability, and because you are your own bank, if you need money during this time frame, anything that's in the cash value is immediately available for you to draw upon to take advantage of another deal. And then you're insured, whether it's you, because this is your own policy on yourself within your own business, within your own fund, where it's all a dedicated single purpose, single person Oz investment, then all that death benefit goes to you. So you've got a number of ways to play this, depends upon what hat you're wearing in the game and where it comes into this.
But if you go 20 years, don't you get your tax liability down to zero?
No, the original capital gain is always going to be taxed at the end of 2026. And depending upon when you make your investment, the maximum you can get is a 15% reduction, which is why some people are scrambling to get their investments in by the end of this year, because by the end of this year, you won't no longer be able to go 7 years. You'll still have the 5-year potential. Some people, that isn't a big amount of money on a reduction of their capital gains tax, so it isn't a big deal. But once you get to the 10 years, you have the full tax waiver on any appreciation in that property. But you may decide on that investment that you don't want it to be a 10-year investment. You want it to go till 2046. And you can let the whole thing ride, and then you have to cash out it in 2046. Whatever gain you recognize at that time will be tax-free. And as far as we know, the policy or this whole program will end at that time. My expectation is if this works well to rejuvenate a bunch of distressed economic communities, we'll see a follow-on program of this nature within 5 years. But I think they're going to sit on it for a while to see how well it works and how much it's costing everybody net in taxes before they dive into that.
Might be on an accelerated schedule because Baltimore's in the news recently.
Speaking of Baltimore, Baltimore has a number of opportunity zones. I've worked with the Maryland Opportunity Zone group there. They have a meetup group. I was one of their speakers a few weeks ago. And there's another new fund that's getting a lot of press that's working in the Maryland-Baltimore area, which we may be able to get that information up into our guide so you can follow what they're doing. But they're working real hard to share information as well, so it's good to see any group that's getting out there and getting stuff done and sharing information. Other questions? Okay, then we're going to call it an evening. Thank you all for coming. As I said, you'll get the slide deck within the next day or two, followed by a guide in the video probably within about a week. And then obviously, if you have any questions about any of this, feel free to give me a call. We're going to be trying to learn more about this project in Florence and then see what other projects we can set up that can use the same approach to get more benefits out of an investment than you would in a classical format. So thanks you all for coming, and we'll see you hopefully on August 22nd, where we're going to talk about opportunity zones and skills training.